Good afternoon, everyone. Morning for some, evening for others all over the world. Welcome to today's live trade session for TPO. Of course, today is January 14th, 2021. And we're going to be starting today. Again, once again, we have a lot to go over. A lot of different trades that we've been looking at. There's just a lot of different opportunities that are available for traders. And so we will be going over a wide variety of what is available in the triple play options repertoire, if you will. Before I get started, a couple of announcements. One, I don't have a slide for, I just simply spaced it. But next Tuesday, I'm going to be doing a webinar on hedging. Again, I did one about a year ago, right about a month before the stocks crashed. I'm doing it again. It's relevant now. Everybody, if you have a stock portfolio, you should absolutely be implementing some sort of hedge strategy. That's going to be next Tuesday, or this Tuesday, as it may be. So this Tuesday, right after the markets close, 4:30 Eastern. If you're in the all-in, you'll be getting, or an all-access pass, you'll be getting the registration webinar, or excuse me, registration email for that. And it will also be posted in PDS Trader. If you're not a part of the All Access Pass, number one, you should be. So you should give Spring a call and get on board. And if you're not, then and you want to attend this hedging webinar, then you'll need to pay 97 bucks. There's a lot of good stuff on it. I'm not going to go into that right now. But I do want to make that announcement. Also want to make, again, remind you that in the very near future, you'll be able to buy stock in Trade Partner, even if it's just $100 worth, something for you to be able to be a nominal owner of the very platform that you are trading with. And who knows, maybe that'll grow into a lot more at some point in the future. Nonetheless, I've done a presentation on that. If you haven't watched it, contact Springer Support and they'll get you the link to watch that as well. Talks all about the great things we have going with Trade Partner. All right, for those that are new on the call, I do want to welcome you to today's call. However, I do want to warn you that I don't explain everything about these trades on the call. These are not meant to be one-offs. They are meant to be cumulative, so you want to continue to attend these in order to really start to understand what it is we're trying to do and why. I also want to warn you that these trades are fantastic, some more fantastic than others, but nonetheless, none of them are the holy grail, which means that you cannot throw caution to the wind. Don't get involved in these. Look at the trade and say, oh yeah, this is a great trade, I'm going to do a whole bunch. If you've never done it before, or if you're just starting out, even if you've looked at it or been attending the calls for a while, you still want to start with one and then begin to increase. And the reason you don't need to start big is because the money management can grow your account for you. And it can do it fairly quickly. As a general rule, if you're averaging about $100 a week over the course of 6 months, you're talking about growing your account to as much as 30,000 in profits. And you can start with a small account, trading one, and that's what can happen. You'll notice that if you don't use compounding, you'll actually only have about 2,500 in profits after 6 months. If you can average $100 a week, no compounding, you're going to be up about 2,500. So the compounding increases that 2,500 into 30,000. That is a huge difference. And if you continue that compounding plan and continue to be able to average that, you're talking about growing it to well over 3 million after 5 years. And if you can't average that, and most of you will not start trading this by averaging $100 a week. However, if you get to that point, that's great. But if you can't, let's say you never get past $20 a week, where you're still talking about growing your account over a 5-year period more than the fastest growing stock over the last 7 years. which was Netflix, and that says something. So our goal is not to make a killing on every single trade. We're just trying to make a little bit every month. The more we can make, on an average basis, the better the compounding is going to be. Now, having said that, I am, because this has come up now several times since I did a webinar earlier this month with regard to my outlook for the year and the strategies that I'm focused on this year. I mentioned something that is called cross compounding. And cross compounding is something that I address in the fixed ratio money management course. And it is very, very powerful. And so I mentioned that, and there's been several questions about that. And so what I'm going to do is on, I believe I'm going to do it next Thursday, is what the schedule looks like. So, excuse me. So next Thursday, I will be looking at doing a small section in this call, so the TPO calls, on cross compounding. And it is relevant for this call because there are trades that you don't want to compound according to this compounding plan, right? And this has come up in the Q&As a couple of times on what kind of compounding plan do we use for each of these different types of trades. And for the most part, you can use this compounding plan. The max risk, again, I've discussed this again in previous calls, but the max risk is a general guideline, and really it has to do with what's the probability of realizing the max risk. If you have a pretty high probability of realizing $150 risk on a single trade, then that's going to be something that you want to pay attention to, and you might want to be a little bit slower on the compounding. However, if you've been taking these and this $150 not a high likelihood of occurring, then you can actually be faster in the compounding. And so if your max risk is, let's say, bigger at $300 or $500, which some of these are $500, but the probability of realizing that $500 max risk is virtually nil. It's not impossible, but let's say 97% you're not going to hit that $500. Especially when you're talking about exiting early as opposed to holding on to the last second. Then again, you can still use this compounding plan or something very close to it. It just totally depends on where you're at and the types of trades that you're doing. But you get something like this. This is what I have on right now, and that's a whole nother story. We have to compound this much slower. We have because this particular trade requires a lot more capital, and technically there is a lot more risk on this trade. Very high probability of success, but there is more risk on the trade, and so you have to account for the risk. Even on when I say if we have a $500 risk and the probability of realizing that risk is not that great, you still have to account for it with regard to your trade size and with regard to where you're compounding at. So you do have to account for that, and you may have to start slower and then increase the rate of your compounding. All of this stuff, I would strongly suggest that you go through the compounding course again, because it will give you a much more, it's 10 hours for a reason, that compounding course. So with this one, we have to be much slower. This particular trade required about 10 grand in margin to place on, and technically that's the risk. The probability of that happening was like 90 of that not happening was like 99%. That's not 99% probability of success. That's 99% probability that you're not going to hit the max risk on this trade. And it's actually higher than that, especially considering the circumstances and what we've got going on. But nonetheless, you do have to account for it. And so this doesn't compound very fast because you have to do this at like maybe a $2,000 delta, $3,000 delta, and that's assuming that your margin is going to allow you to increase that fast. So you have to account for margin and your account size. Well, basically your account size and the compounding rate, and what margin has to do with that. So, for example, if this requires $10,000, you can technically place this on with a $10,000 account, right? But when can you do two based on margin? Well, you can't do two based on margin until you get to 20,000, right? So you're looking at a scenario where the margin will prevent you from increasing according to a compounding plan, where your first increase will come at like $2,000, $3,000 in profit. So a lot of traders say, well, why use this? Why use this at all? And the reason is because of cross compounding. I may not be able to. So I've made. I don't remember how much I've made off of these over the last couple of months. Trading these 5-to-1s. I've mentioned them at various times. I believe I started mentioning them in the seminar. But it's been quite a few, and so let's say over the last 5 weeks I've made $400, and I've actually done better than that. But let's say over the last 4 weeks I've made $500, or excuse me, $400. Okay. Well, let's say that I've just had a really bad streak in my TPO trades, and I haven't made anything over the last 4 weeks. Well, if I've made $400 from TPO, then my account is at $2,900. And so guess what? Even though my TPO trades haven't made anything, my account has increased to $2,900, and therefore I can place on 3 TPO trades. So I'm actually still able to use the profits from this particular trade into my TPO increase. And so that's something that so on my next trade, let's say I've hit a bad streak, but on my next trade I finally win, and I did a 3 lot instead of a 1 lot. Now all of a sudden, if I do $100 a piece, I'm going to run a 3 lot. Now I've got over $3,200, and I'm going to be trading 4 of the TPO. I still only trade 1 of these because the margin is so high, but I used a combined trade of TPO plus this to increase my TPO. That's how it works. And if you can add, $5,200 wherever you're at with this. So let's say you get up to $8,000 on just the TPO. Let's say it takes you 6 months to get there because you started slow. You made mistakes, et cetera, et cetera. Markets didn't work out all that great, and you're only at 8,000 in 6 months instead of 30,000. But you've been consistently pulling in maybe $50, $75, $100 a week on average on one of these more expensive trades, and over the course of 6 months, that's $2,500. So if you add $2,500 on to the 8,000 that you're at, instead of trading 11, you're trading 13, right? So it's a small contribution, but over time it just absolutely escalates the compounding effect. So that's why I place these on, because these TPO trades that we talk about, like this one that we'll talk about today, not a lot of margin. I mean, obviously there's some margin, doesn't require a lot, but you get to a 10 lot on this, and you're talking about a margin of about $7,000. And well, actually less than $7,000. So you're getting to the point where you're maxing out the margin here, but that begins to drop as you go bigger. So for example, 20, if the margin is $700 on a trade at a 20 lot, you're talking about using $14,000 in that, right? So obviously this type of trade this type of trade has to be done with more money in the account in the first place. You have to have at least $10,000 in this in your account to do this. And I would suggest if you're doing a 5-to-1, you can do a 2-to-1 with less. But if you're doing a 5-to-1, man, I would suggest $40,000 to $50,000 in your account in order to do this. Just simply because in that one weird, bizarre instance where you actually suffer a larger loss on this, which is again very, very low probability if you put them on right. You don't want it to wipe your account out. You don't ever want to put yourself in a position to wipe your account out, right? So here's the 2-to-1, and this is actually one that we still got on, and this one is just kind of hovering. At the time, this was about 2 weeks ago. I actually had, not quite 2 weeks ago. That's not true. I guess this would be a week ago. Had a profit, and this one I believe now is at a loss of I think I checked it earlier and it was like $30 or something. Yeah, $25. With the market trading right in the middle of the profit zone, but because there's still about a week to go, that one is just kind of stagnant right now. So this next week, if the market doesn't skyrocket over the next week, this will be a nice winner. But this was a credit of 80. And I'd put a target on this one at like $40 or $50 and be done with it. Excuse me, go on to the next one type deal. This one, I think this one actually hit $47 or $48 profit before the market moved up into this profit zone really early, and it's just kind of been sitting there recently. So you can do this one with less money. Still, another $40 if you can add $40 a week, because as you can see, the market was trading at 368.50. At the time of this screenshot, it was way down below the profit zone, and it moved up here really, really fast. And so it hasn't given us a chance beyond that to get out of this trade. But this option insanity, that one takes about $4,000 in the account. So with this one, you're going to want between you're probably going to want between $15,000 and $20,000 just to do one of these in the account. And again, if you've got a $25,000 account and you start with one on this, obviously you've got a lot of money sitting there, not working for you. And that's why I say, do something like this, use that, and give yourself a really high probability of success. If this isn't one that you want to do, I'll show you something else. As far as option insanity goes, and the option insanity that takes up a little more money, but it is nonetheless one that is available. The probability isn't as high on this one either, but I'll bring this one in here. All right, so here is, and we'll throw this up on the risk graph here. This is if you've gone through the option insanity stuff, this is one of it's a typical trade in option insanity. You have to have your margin hedge in here first. It requires 2 margin hedges actually, because you're actually short 2, right? So it does require margin hedge there in place. The margin hedge can be generally a little bit closer, because these you can actually place on right at the end of the trade. So I placed this one on the 12th, which is a couple of days ago. These are actually some of the best trades when they're placed on like the day before expiration, which is today, right? And you can see here I got into this trade for $1.86 credit. It's now trading at a $2.20 credit. So I'm losing about 40 bucks basically, not quite $40. And so this one is one where you'll actually lose money if the market doesn't move anywhere. It's not lose a whole lot, but it is one where you lose money if the market doesn't go anywhere, but you make money if the market moves up, and you make money if the market moves down. $186 if the market tanks. And the risk on this is really, really small. So if you want to put something in there to maybe give yourself a high probability of making money in a situation where if the market is stagnant, you've got another position on that's going to make money. And I'll show you what I'm talking about here in just a second. Let's go ahead and put this in. As a matter of fact, let's put this in a risk graph. Let me put this up here. So I'm going to get the option insanity stuff done first, which I wanted to mention this. So let's go. This was I forget what this was. Let's take a look here. This was long 377, long 379. All right. So we are still having, by the way, we're still having an issue with data in SPY with PDS Trader. Again, it's not us, it's our data provider. We're waiting on them. But there is a workaround on this, and it's really simple. And actually, as I've been using the workaround, it's actually faster than going and putting in the right data anyway. So, so I said we were long a 377 and a 379, I believe is what I said. Is that what I said? Long 377, 379. Yep, and then short 377 and 378. So we'll go there and 378. All right, so I just put all of those from one expiration, no big deal, and then I just go in here and I change the expiration right there, and then I redo the prices. All right, now I'm in this from a $1.86 credit. So I don't know why that says a buck. Oh. It's 115. Sorry. 115 are my longs and 119s are my shorts. All right. There we go. So now I'll refresh the prices on all of those. All right. So that says 205 credit. Now, I also know that the volatility is not going to be as high as it is showing on my shorts, so I'll drop that down again. And so here is a scenario where there's actually a loss zone here, and if volatility actually comes out more than what I've just said, and it most likely will, that actually is a smaller loss zone. So why would I put this trade on? Well, I have a bunch of calendars at the 377 level here. So on this one, if I've got a huge profit peak, but there's a loss, or there's not very much money to the downside, or there's a loss to the upside, well, all of a sudden now, I can add this to it, and I've actually got a pretty good trade on. Here's what last week's volatility was closer to, and I do expect this week's to be fairly similar. So if I hold on to this trade by tomorrow, look at this. We're talking about maybe a $50, $50, $60, $70 loss potential at that point in a small range. But if the market moves up, or if it crashes, then I make money. So this one has a little bit lower probability, but because we are talking about a loss zone that is fairly close to where the market is, but any kind of movement, and you're talking about significant gains on this, or a decent gain, I should say. So I put these in conjunction with where I've got a huge profit zone. If the market moves into that area, that's where you get the best pricing, and we'll take a look at some of these. But that's just another way. It takes a little more capital. This one takes about $2,500, $2,600 to put on, because you're doing it fairly soon, fairly close to the expiration, and then you're just taking advantage of either price movement or time value dropping on that. Okay, so let's move to what I placed on Monday's call. So this is the, at the end of the call, I just kind of threw this together, and this is what I placed. I placed it at 34-cent credit, and it was a short 381, short 384, and then long 2 385s. Right, so that's my core trade. That's basically a TPO bearish pattern 1. And I got filled at $1.42 credit on that. I did not get filled on my calendar spreads that day. So let's see here. So right now that is still trading at a $1.42 credit. This is for next week, by the way, not tomorrow. This is for next week. Trading at a $1.42 credit. And I ended up getting filled on the calendars the first thing the next morning. I did not get filled on the calendars that same day. I got filled on this like 30 minutes after the call, I think. And then the next morning, I got filled on the 4 387 calendars from 20, I want to say 27 cents. What was my order for? Hang on one second. Yep. So that was filled at 142. It's now trading at a 138. So making $4 on that. It's filled on the calendars at 27 cents. Those are still at 27 cents. So this trade hasn't moved much at all over the last couple of days. You can see here the calendar spreads expired that day. But again, the next day I put them on and they got filled fairly quickly. And the reason I do that, if I don't get filled on the calendars the same day, I don't keep the order automatically in for the next day. I don't do a GTC on the calendars. And the reason is because if the market opens down, then I may be able to get a lower strike calendar. And for the same price, and if I can do that, that's what I'm looking to do. And I actually did do that with another trade, but on this one, I stuck with the 387s. I got filled on the 387s, and this is what it looks like. And the reason that I would go lower on the strike, if at all possible, is because that brings this profit peak a little bit closer to the original. Or to the main core trade. And the closer I can get the calendars, the better off I'm going to be. All right. And I did a 4 lot, not a 5 lot, not a 6 lot, because I could have easily done a 5 lot and still had a credit on this. And that would bump this profit zone up a bit. But this is a low probability. And so I didn't do that specifically because the probability was not very, it's not very high that it goes here to this level. And I wanted a small credit on the trade. So I have $34. The market tanks. It's not a lot, but it is something on this trade. All right, so that was the trade I put on at the end. There are some trades that I have on now. So here is one that expires tomorrow that we discussed late last week. 381, 385, 386. And that currently, I was filled at $1.38 credit. And that has $86 in profit. And my calendars that go with that, which are 386s, filled at 23 cents, are losing $48. So I've got basically a $40 profit on this. I would, if you're in something like this right now, I'm going to tell you right now, they are going to tank the volatility tomorrow. And these calendars will probably, I mean, they're already down to 11, 12, 13 cents. And you know what you don't want to do is you don't want to see the market move to, let's say, 384, 385, which I don't think it's going to happen, but my track record on predicting market action. Sometimes it's not very good. And so, you got to prepare. Man, I would probably exit this trade before the end of the day, and just take my $40 and skedaddle. It is true. This has another, this credit has another, where are we at? Has another $50 available on it, if the market stays below 381. And this one probably not going to lose a whole lot between today and tomorrow, but because I am 4 of them, another $2 or $3, $4, and it just starts whittling away at the profit. So I've got a profit. There's really not a great deal of probability that this is going to get a whole lot better. But if the market moves up, then and volatility tanks, these 387s are not going to be, the 387 calendars are not going to be this like gigantic profit producing balloon for me. The third week of the month is always the worst for calendar spreads in SPY. Okay, third week is always the worst, or third Friday. And I believe tomorrow's the third Friday. Yeah. So on this, I'd get out and be done with it. If you have anything even close, and I've got several like this, as you can see. I've got one that's a little bit tighter, 381, 384, 385. That one's at $68, and then I've got the 386s. Here's 386s from 27 cents. So this one is only making about $30. If I'll probably get out of this one by the end of the day as well. I've also got this one in place for a 381, 385, 386 from $1.30, which is the same as this one up here for $1.38. It's because I got into it several times. So as I get in the calendars, I'll add to the trade, in other words. So anything like that, go ahead and get out. Of course, we're in one where we've got 377 calendars, and I don't know. That one's not on the spread thing, and I've got between. Let's see. So this one it's what's called. You'll notice here up here the trade partner is not trade partner. It's actually our development site, and that's how I get to the spread patterns and whatnot. So between this one and the actual development site and about 6 different accounts, that's 12 different areas that I've got spreads, because this one doesn't show anything that I place on the normal development site, even though it's in the same account. It doesn't show in the spread box. So I've got about 12 different spread boxes that I have to look for where I've put different spreads. It's crazy. So that is a normal TPO bearish combined with the calendars is what that is. And that's exactly what this is. This normal TPO bearish combined with calendars. This week and next week, not the best for volatility, not the best for calendars. And so this is definitely one that you have to be aware that you're going to want to take a profit once you have it, $30, $40, $50 on this type of trade, because likelihood of it getting any bigger is not a huge there's not a huge probability of that happening. Obviously, we have a large range here, so if the market immediately moves up, we're fine. There's nothing to do. We just stick with it, and that's that. All right. So let's take a look at one that I also got some more questions on. Let's see if I can find it. Here it is. Did I stick one in here? Let me see here. Yes, I did. All right. So last month I did a risk-free calendar call webinar presentation, if you will, focusing on that. And I talked about different ways of trying to put on risk-free calendars. Same way, same thing with crazy calendars. There's different ways to put them on. You don't have to put on this type of spread to pay for calendars. You can put on something else. My favorite is just to simply do sell a short way out of the money, and the reason is because you can bring in a lot more premium that way, and you can buy a lot more calendars for cheaper that way because you're going further out of the money. Which I'm not going to get into right now. So I'll get into that if we have some time here in a minute. All right, so because I still do that, that's still my favorite way to place the crazy calendars is through selling an option instead of putting on this big spread and then just going further out of the money. Let's see here. So this one is a core trade spread designed specifically to attempt to put on some risk-free calendars without risking being naked a call, which some of you can't trade in your account. You cannot just simply put on the short leg of a calendar and then once it's filled, put on the long leg of the calendar and wait for it to be filled because they don't let you. So in your situation, you have one of two choices. You either have to create a core trade with which that is available, or you have to put the long leg on first. And I do not suggest putting the long leg on first because you are immediately putting on a negative probability trade as opposed to a positive probability trade, which would be the selling the short leg. So I don't recommend doing that. You want something where the time value is in your favor. And so this is one where the time value is generally in your favor. And it is a 2-1-3. Let me see if I can't increase this well, I don't want to increase it that much. All right, so let me pull this over. So this is a 2-1-3. Hopefully you can see the two. It's a short 383, short a 388, and then long 387s. You'll notice this is out of the money. The break-even levels is looking at about 385. It's 385.50 is what this shows. It's probably going to be closer to 385 based on volatility dropping. But nonetheless, it's a fairly decent trade from the standpoint that you've got a big credit and you've got the profit peak is out of the money, and you can put on a bunch of 386s or 387s, and you should be fairly good on this trade. And the one negative is that the risk is a little bit bigger. It's a little bit more than $500. But again, the market has to just go way, way up there. And if you add calendar spreads to it, obviously you have to add the cost of the calendar spreads to ultimately to that risk, even though that's, again, very, very low probability. All right, so the purpose of this then, once you put this on, is to add a 125 388 long leg. Okay, and you want to add this 388 long leg at the same price as your short 388. So when you do that, you are basically creating a weighted spread at that point. You now have 4 longs to 3 shorts, but you still have a credit because you're long from 63 cents on a credit of 179. So let's go ahead and do that. Which one is this? This is SPY 2. So we're going to add 388 to SPY 2. I'll change the date here. And that'll be 125, and we're gonna add it from 63. All right, so that will be our first risk-free calendar spread that is in the confines of a core trade. So now I have a $1.16 total credit, and I've got one risk-free calendar spread on. I've got all sorts of things I can do at this point. If I wanted to, I could just simply get out of my original core trade spread at $1.79 and leave my risk-free calendar in place, right? So I can get out at a break even and be done with that. Or I could then place on an order to sell another 388 call. And if I do that, then it creates a little bit more of a profit potential. Again, adding to my credit, I'm back up to 179, at which point I would then put an order to buy another call. And once that's filled, once again, I have the opportunity to either exit the core trade and just have now 2 risk-free calendars, or I can hold on to the whole thing. And obviously the profit potential here is much better if the market stays the same. So the probability is the profit potential. So I generally like to look to at least take a profit on my core trade. But if we're moving up, so if we move past the profit peak, depending on how much time is left, you'll still be able to take a profit or a break even on that core trade. And that's probably what I would do if I move up to here. So while I remain down here, I'll probably keep the whole thing on and just keep adding it as often as it allows me to. So that's the process of that. We're going to put that in a trade partner. Well, first we're going to take a look at the different spreads. I'm going to show you something here. So this is, I'm going to move this over. All right, so this is the same spread, a 213, right? So sell 122, sell 122, buy 3 125s. All right, and then I'm selling 2 and selling 1. Right, so that's at $1.62. And so it's actually trading at a smaller credit now than it was earlier. So I'm going to reset this and generate the spreads again just to get the updated prices. So on this, we're going to go through here. We're going to start taking a look at this. All right, here we start with 380, and maybe it will update the prices. 380. So I don't know if it's my internet again. It always seems to slow down. Y'all can still hear me, right? Because it seems to have frozen. Okay, hang on for me 1 second. Let's see. All right. Well, so much. All right. So let's take a look at this one. All right. So this is 381. I want to go to 380. What's actually 383, right? Yep, that's the short. So 383. Let me show you. So this is 383, 388, 387. That's 122, 125, right? Everybody see that? This is tomorrow's. So this is in 1 week. 383, 388, 387. It's trading at a 10-cent credit. Okay, do you see that? So if I do nothing else, this core trade that I have on is actually really valuable. And if I add on another 388 long, well, the 388 long is only going to be trading for about 10 cents. So my 116 credit would be worth about $100 at this point. So this is why I say this is still one of those core trades that allows you to put on a core trade and the potential for putting on some risk-free calendars with a core trade where the time value is very much in your favor. In fact, if we put on that trade at, let's say, $1.70 credit, where does the market have to go for me to be breaking even on this one? So we look at about 379, 384, 383. So this one is 4 points. 4 points from the current one, which means that in 1 week on Thursday, if I put on this one at 170 credit and the market moves up 4 points from where it is right now, then I'm probably going to be breaking even on my core trade. And I'm hoping that my my calendar spread is, if I put on a third long, hopefully if I've put on a third long, that it's going to be worth something. Obviously, I will have been able to add at least one extra short on that. All right. So if I wanted to, I could get out of this thing at a break even. Market's trading up 4 points. I can get out of break even. I've got my calendar spreads on that are actually really close to the money now because the market will be trading about 3 points away from it. So should have some pretty decent profit on those calendars on however many I put on. And it's a pretty decent trade. Obviously, the more calendars you can put on, the better off you are. You can also be really aggressive with this thing, and you can go. So let's get back to the one calendar. And again, I'm going to put this in a trade partner file, and I will send it to you as a template. Okay, as a template, because again, it changes based on whatever was filled on the first day. Okay. So this is the original trade right here. Let me update this. And all right, there we go. So this is the original trade. I stick on an order, la-di-da-da-da-da-da, wait for it to get filled. I actually could do 2 of these if I wanted to. Right, I could actually do 2 of those, and I'd still have a credit of 53 cents. And let's update that again. All right, so I still have a credit of 53 cents. I know this shows as a risk-free projection, but I didn't drop the volatility in here yet, and you definitely want to do that. So I will drop it just a bit. So there is risk if you don't do anything else and the market moves up and stagnates and you hold on until the last minute, you'll have an open position loss. But once I sell these 2, if the market moves up, I have a very, very high probability of being able to place on 2 more of these. Actually, I'll go 3, right? Because I did 2 of the longs, and now I'm going to do 2 of the shorts all at once. And I go right back up to my credit on that of 179, and I immediately increase my my risk-free calendars to 2 at this point. All right, so I jump it by 2, and I can do that again. Right, instead of jumping it by 1, I can jump it by 2. So let's say I get in the long, and there's there's what that looks like. I don't want to hold that because there is a dead zone here at 385. And then pop that up to 5. I now have 4 risk-free calendars in place. Again, this is a process, obviously, and it just depends on how often the market allows you to get those. So I updated that. There we go. So again, I have all sorts of opportunities to exit the core trade and then just have my risk-free calendars in place and do, hold on or take a profit on the whole thing or whatever the case is. There are going to be some weeks where you don't get very many on this. There's going to be some weeks where the market moves down, but you have a significant credit, so that's great. And then there's going to be some weeks where the market moves up and you never even get a single one of these risk-free calendars in place. And at that point, you're just looking to get out at whatever profit you can get if the market moves up before you ever stick on a risk-free calendar. Let me refresh that so you don't get confused on that. Okay, so that's the trade that we're going to look at today. Is we're going to put this one in a trade partner spreadsheet. Actually, I'm going to do it from here. All right, so market's moving down just a bit. So here we are. We're 379.84 currently, and again, close to a $40 profit on that trade. About a $40 profit on this trade. And et cetera, et cetera. All right. All right. So let's just go to smart orders and I'll create a new one. And we're going to do the core trade first. I'm going to do a 383. Well, the market's moving down now, but oh well. 22.25. So we're going to do a 383. Let me increase the strikes real quick. All right, there's that one. 383 and a short 388. And then long 387. And remind me to show you one alteration of this after I get done. One slightly different variation of this after I get done. Okay, so we're going to do 3 of those and 2 of these, and now we're down to 144. 144 call. Oh well. The idea would be to add a 388, right? So add a 388 to go against this short, and so we'll go to 125, buy a 388, and there we go. So I want to increase this 1 second. So you can see this. All right. So I'm going to go execute order 1, right? And I'm going to say credit 150 because we have moved down here. It's a day order. I don't hold these overnight. I look at it again the next morning because a gap opening can definitely change what you're able to get into. And so, for example, if we move up 2 points on the open tomorrow, I'm going to be able to go 2 points higher on these strikes, and I will always opt to do that on these. All right, so execute order 1, 150 credit, and then I'm going to say if order 1 is filled, then execute order 2 at a limit of. Now I could do a couple of different things. This one, it's going to be trading at around the 388. It's going to be trading at around 55 cents, 56 cents. If the market moves up to 150, this whole spread moves up to 150. So I can just say, do it at a limit of 0.55, right? So it's going to have to come down just a little bit, and that one will be a GTC. You don't have to do that, but that's the whole point. However, if the market moves down, so if you don't get filled on this tomorrow and the market opens down 2 points, you might be able to get this thing for 35 cents or 40 cents, or you might be able to go a 387 strike for 55 cents. If you can get a 387 strike for 55 cents, now you've got a big old profit potential on your hands, because you just created a risk-free debit spread of 1 point. So you've got $100 of profit potential to the upside, no matter how far it goes up, which also obviously decreases your overall risk. So you don't have to do it that way as well, but I just like sticking with, if the market moves down, I should get a better price than 55, but man, on the open, they can really ream you, where they'll fill you at 55 cents and the next tick will be 40. So even on these, I don't like doing it this way. But because I'm showing you the structure, that if I'm not filled on this long, I still want to be getting into another long the next day, if possible. Okay, which one that is and at what price, that can vary based on where the market opens at. Now, once that's filled, then I'm going to add an order, and I'm going to sell the 122 388 call. And I'm going to do it for basically the same price. So I'm going to go, if order 2 is filled, then I'm going to execute order 3, and I'm going to do it at a limit of 0.55. So I'm going to resell another 122 388 call at 55 cents. And then I will say, if order 3 is filled, then execute order 2 again at a limit of 0.55. Okay, and that's how you do it. And that will just keep going until you tell it to stop, or until it gets everything filled, however many iterations you have it working for. Okay, so that's fairly close. So what I'm going to do is I'm going to send this out to everyone as a template, and I'm going to call it a template. Actually, I'm going to say core trade risk-free calendar template, so you understand how it works. This is a template for the process of creating risk-free calendars. How's that? All right. Now I am going to go ahead and turn this on, and then we'll go from there. It really depends on whether I've already got some trades there on or not. But this is the variation that I wanted to show you, where you could go smaller, on this. Let me show you here. So we're going to reset those. Here's a 40. Well, now I've got to hit the save changes. All right, so this is a 388, 388, excuse me, 383, 388, and 2 387s, right? Which 49-cent credit. Can't really do anything with that. If you were to buy another long, then you've actually got a debit on the trade. It's a small debit, but it's a debit nonetheless, right? So what I would do, if you wanted a smaller credit, but with pushing that break-even level up there just a little bit further, is a 1, 2, 3 trade. And that's the 1, 2, 3 trade. The problem is you've got this dead zone, so you really, really want to do something with that dead zone. And there are some that don't mind creating debits. If you've got a lot of credit on other trades, you can go ahead and do that. All right, so you can go ahead and create the small debit. There we go. You can create the small debit, obviously with anticipation of possibly creating another calendar at that point. And we go 155. All right. All right. So that is where you put the bulk of the shorts higher up. Okay. Still ultimately have, whoops, let's see, 1, that's 5. I actually need 2 of those. There we go. Let's do this again. So it's basically the same process. You're just dealing with a scenario where you may have to put on a small debit to begin with. But once you get that process rolling, it's actually a much lower risk trade. I would play with that a bit, and if there's interest, I can spend more time on it in the next call, because it is a lower risk trade. You just have to start off with a scenario where your first buy will ultimately create a debit on the trade. And so if you've got anything else that is working on credit, then not a bad one to start with. Okay. Let's see here. And I'm going to move this over. Let's see what questions we've got for today. The 377 call trade. So I will actually be looking to exit. So if my calendars are in the money, I look to exit the calendars at a profit and then put an order to exit the underlying. And so the calendars, my 377s, I'm going to exit probably at 85 to 90 cents for tomorrow. The trade that I have 377 calendars on, I'll exit those at an 85 to 90 cent target tomorrow, because we are trading past those. And then I'll look to exit the core trade either at a loss, giving me a net profit on the entire trade, or obviously if the market then moves back up before that gets exited, then I end up maybe taking a small loss on the entire trade. But I don't have the risk of the calendars anymore. I've actually locked the calendar spreads at that point. Okay, let's see. Can I post Dan? Yeah, let me. Dan, I think I sent you by email that link. I'm almost for certain I did. If I didn't, let me know. Let's see, on 323.20. Oh gosh. Josh will probably in the seminar somewhere, but man, that I would have to look. That's going way back. And that was a question on the box trade. You got to understand the trades that we are doing in March and April of last year are not relevant for now, for the most part. There are some variations that are, but those were the 911 trades. Those were trades where we were taking advantage, huge advantage of the increased volatility because markets dropped. So, all right, let's see here. What about adding buttons at the top? So you can click to add and fill in legs so you don't have to go all the way down into the options chain box below. Oh, well, that might be a good idea, actually, Mark. Wow. Not sure why we hadn't thought of that. Hang on for a second. I'm going to write that one down. Add box. Without. Okay. Can I show you something else? Show you something else that we've done. Again, this isn't available yet, but let me see if I can't pull it up here. Oh, nope, can't do it on that one. So I'll do it on this one. I am not filled on that initial core trade yet. I'm going to bring this down. So we did something that's a little bit different. So this isn't available to you guys yet, but when we have the option chain, I also created a different look for it. And so we have all the expirations side by side. And so you can just compare the strikes of the different expirations. And I can scroll, I can have more expirations and scroll that way, or I can have more, more strikes and scroll down as well, right? So that's another way that we've used to increase that. All right, let's see. We want to trade with the 387 calendars have a large dead zone because it is 2 strikes above. Yes, there will be a dead zone in that trade, which is why I say we would not want to hold on to that until the very last second. We're not going. We're not trying to create the massive profit peak with the calendars. Let's see, when can we get spread patterns in TP? They were supposed to be adding it today, so I know they're working on it to add that. There's some other issues that they have to make sure are taken care of, but they are adding it like ASAP. No, I've not talked to the owner of TradeR about foreign accounts yet. He's very difficult to get a hold of, as you can imagine. So, but it is on my list. I speak to him every couple of weeks. Isn't the 1, 2, 3 pattern short 1, 383 calls, short 2, 387 calls, and long 3, 388 calls? Philip, so that's one way of doing it, but you can't necessarily create the credit in doing it that way. Did I ever sing and acquire? You've got a good deal. No. Nope. I have never sang in a choir and never will. As far as a choir is concerned, that is not a gift of mine. I can't carry a tune. How's that? Let's see. You talk about 2-to-1 and 5-to-1 option standing trades. What about the 3-to-1 and 4-to-1 as our current account size grows? Jordan, that is a great question. And it's a great question because all of this is available. It absolutely is. Let's take a look at the 5-to-1 here. This is actually, let's go to the 129.21s. This is one I'm in, 377s and 387s. This was trading, as you'll recall, on Tuesday at a $600 credit, even though we weren't trading any higher, right? Because all of this is time value. The whole thing is time value. And so here we are, almost $300 better on Thursday. But on any of these trades, you can absolutely create a 4-to-1, and by creating the 4-to-1s, you are creating a similar situation. There is, let's see here. There's got to be an issue. Seeing this is this is why we haven't added it yet, even though I keep telling them add it. Here's all of a sudden I'm having an issue pulling up new prices on here. So if I do a 377, where is it? 377, 387. All right, so it's the exact same strike difference as what I've got, only on a 5-lot. Now I've got less risk and I still have a credit of $200. If I do a 3-lot, whoops, not up, down. If I do a 3-lot, now all of a sudden now I can't go out 10 strikes. If I were to put this trade on brand new. So instead of doing a 1-2 lot, I go smaller strikes. Now that I've got a 1-3 lot, I can't do a 1-3 lot and create a credit. And so guess what I have to do? I have to drop my strike by 1. And so now I've got a 1-3 credit, still way out of the money, and an 86 cent credit, right? Right. So if I drop this to 2, now I've got a $1.78 debit, and all of a sudden now I have to drop my strikes by quite a bit, actually. And so here's 377, 383, right? So this one's actually in the money at this point, or not in the money. It's right in the middle of the profit zone. But that's the process. The peak of the profit zone in this one is actually 383. So you can go into PDS Trader and play with a couple of different variations of those. I guess I don't have any on here, but you can play with those. You can also do it on PDS Trader, except for the fact that the data issue is they're still working on the data issue there. All right, so let's see here. When will the spread pattern be available? Yep, just answered that. Let's see where, there we go. All right, so now it is working. So maybe it's just my internet. That is like, there we go. All right, so here is 377. Here's the first credit that you can get on a 1-2, 378, 384. And the middle of the profit peak would be at 384. So that's not bad, but we've got 2 weeks on that. So that's how you start to look at the different different ratios and strike distances, which is what the ratio affects. Is there a template for the 1-5 trade, or do you just look for standard 1-2 option? All right, so I know there's a guy on here. He goes as far out as he can go and gets a 50-cent credit, and that's his MO on this thing, right? So if I go, if he were to do that, yeah, so he's looking at going maybe, let's see, how far out can he go? Oh, I gotta change the, sorry, I gotta change the, That's 1 to 5 and 387. So he takes this one. So I'm going to go 3 and 397. All right, so he will go as far out as he can and get 50-cent credit on the trade. And so on right now, he could do that at 381, 391. I actually know for a fact that he currently has on the 388, 388, 398 from a 50-cent credit, and it's now trading at a debit. So he takes his 50 cents and goes to the next one, to the next expiration date. And so if we were to do that, it'd go 2528, and then generate the spreads again. And that's his strategy. All right. Whoops. And you can go all the way out to about 388, again, 388, 398. And in 1 week, this 388, 398 is probably going to be at a 50-cent credit or at a $50 profit, at least if the market doesn't go anywhere. But look where the risk doesn't even start on this trade until about 400. So he's going super high probability and just going for $50 a week type deal. Okay, so there are different ways to approach it. I like going with a little bit closer and going with $100 to $150 profit in a week if I can get it based on time decay. All right. What about putting a butterfly in the middle of a dead zone? Well, the butterfly, it depends on what butterfly, and depends on the price factors and the profit peak and all that stuff. But you can always look at that. Obviously, the more complex you get, the harder it is to exit. So the more trades you put on to try and address something, the harder it is to exit. Let's see, can't even see for probably paying 24 with volatility such a drop would be great today. So yeah, that's a C4 question. I have an exit generally of 5 cents working on those. So if I have a 380 short Friday expiration, 381 longs, Monday expiration, you're saying because the drop, the volatility of the long on third Friday, that if you short stayed out. No, that's Andrew. No, that's not what I'm saying. If you have 380 shorts and 381 longs, you don't have a dead zone. Okay. You don't have a dead zone there. If the shorts stay out of the money, you're going to make at least the credit, guaranteed. All right, so I guess maybe I should spend a little more time on a dead zone on Friday or on the next call. So let's talk about dead zones again. I'm just writing myself a note. All right. Unfortunately, as I live in the UK, I can't open a TRADE-REC account. TradePart to be able to work with interactive brokers. We are working to add interactive brokers, Mark. If you have TD Ameritrade, we have TD Ameritrade. It's hooked up to TD Ameritrade, so that's available. If a position is positive and I haven't reached the peak, should I be in a position to close or wait to expiration tomorrow? Kevin, it is not a good idea to play for the peak profit. That's a very low probability outcome. Every now and again, you might get it, and we have done that in this call before, but it's not the high probability. We're not going for the big profit. We're going for consistent small gains. So if you've got a decent gain on a Thursday, and there's any kind of risk of a jump in the market taking that away and putting you at a loss tomorrow, I would get out at a profit, reposition yourself for next week at a higher strike zone and give yourself another high probability for a small profit. At what point with crazy calendars do you stop trying to add a risk-free calendar based on the core trade? Generally, when it gets so far away, it would be if the market gets so far away, so if the market drops significantly, I'm not gonna try and add to the calendars anymore, because the probability of the market moving up there and giving me a big windfall is very, very small. I actually may try to establish another set of positions at a lower strike, or I may just get out of my core trade, let my risk-free calendars that I've got on sit there, and either they do something great or they don't, because I already took a profit on my core trade, which is what happens when the market moves down. The other side of that is if the market moves up towards the strike, towards the calendar spreads, and the calendar spread becomes so wide that the market has to make, make a pretty decent move in order for me to get short again, or if it creates a debit, et cetera, et cetera. All right, looks like I got all of the questions. Good call today. Appreciate the inputs and the questions. As far as next week, Monday, there is no call unless there is a big move. There won't be a makeup call for Monday. So unless there's something else, a reason, I'll schedule one if stuff is going on in the market. If we take a dive tomorrow, or if we skyrocket tomorrow, then I may have a call on Tuesday. It may be a brief one, so it may not be the full one, but other than that, we're just gonna keep the Thursday call in place, and that's when we'll next meet. All right, everyone. Everyone have a wonderful day and great weekend coming up. Long weekend. Markets close Monday. So, all right, take care.